Good morning, everyone. We are so happy to see you. Today is really exciting. We are presenting from the E3 Alliance of Greater Pittsburgh, Financing Your Business with Jay Mugri from Enterprise Bank. Good morning, Jay.
Morning, Tori.
So we're so excited to have you here. One of the reasons why we wanted to have you here and kind of talk about a little bit about financing your business is the fact that for so many small businesses, there's a lot of misinformation or what you need or how you need in order to find financing or going to a bank or anything like that. So I'm going to let you introduce yourself and you're going to go into a presentation and I'm really excited to hear it. So go ahead, Jay, kick it off.
Thanks, Tori. Again, my name is Jay Mugri. I'm with the Enterprise Bank. We're a small business bank in the northern area of Pittsburgh, Allison Park. We've been in business for about 25 years, and I've been there for several of those years in different positions. So I'm very familiar with the banking world. And today we're going to discuss just getting yourself into the bank and what's the best way to go about, presenting yourself to a bank. So the world of small businesses has grown increasingly complex over the years, different types of lending. While banks are a good starting point to borrow money, there's other options out there as well. Some can be cheaper and whatnot, but there are many options to borrowing money, not just your local bank. So this session will outline what it takes to qualify for the loans, as well as different types of financing. We'll discuss benefits and risks of various forms of financing and try and help you prepare for when you want to leverage someone else's money to grow your business or start your business. Next slide. All right, so here's some different types of areas where you'll need capital for your business, and it all boils down to the purpose of your loan or borrowing money. So your loan purpose helps you identify whether you need long-term or short-term loan, and how much collateral you'll need, and the cash flow and tax ramifications of the loan and the money you'll be borrowing. Different things you'll be borrowing for: real estate, equipment, inventory, research, development, and marketing, as well as your traditional payroll for your staff and your day-to-day operations. So borrowing to purchase a lot or building is a lot different than renting or leasing, or financing for inventory is very different from purchasing your equipment or your inventory itself. So some implications for financing tangibles are very different for lender, because most vehicles, property, or even inventory can be repossessed. So those types of items are a lot different than when you're purchasing or borrowing for real estate. Money for product development, marketing, and operations is harder to find because lender cannot recover anything. There's no real hard collateral for those items if you were to default, and that's what's securing your loan. So knowing why and how much you need is will help you justify, your request for funding when you go into the bank. Knowing what you need is very important. So let's move on from that and take a closer look at the types of financing that small business clients often need. So what we're going to cover next, this kind of summarizes all of this. So we'll have your traditional loans, online lenders, different types of borrowing through family or different investors. There's credit cards, receivable financing, crowdfunding, nonprofit lenders, and your retirement savings rollover. So you can borrow from money you already have saved. So in these different funding considerations, there are various rates you'll run into. So if you get into banking, the rates are, in your lower end, 4 to 6%. And as you move up that scale there, the rates can get up into 25%. And it depends on things like your credit worthiness, the amount of the loan, and the riskiness of your business is a big portion of how they rate your credit, which is your interest rate. and then the type of product you're using to get the money. So in general, lending products with low rates are more scarce, and the loans that are readily available over the internet tend to have higher rates, hefty fees, and penalties if you pay late. So then we're going to look at matching the type of funds you need with what your financing needs are. So when we opened this session, I mentioned that it all depends on your situation and your reason for borrowing money. So if you're looking to start up or add a location, the loan amount can vary from very small to very large. And the typical institutions you'll look at are your traditional bank, family and friends, or some money you already have saved in a retirement account. As you can see, research and development or new products usually are looking for about $5,000 and up. And those are some of the funding types for that are crowdfunding, equity investments, and such. To buy discounted inventory, you see there, you'll need an online business loan. Typically, they're short-term. Rates vary on that. And your payment terms, depending on how often you need money, if it's a rollover type of revolving line of credit, or if it's just a quick one-time thing. Revolving line of credits also come into play when you're managing your daily operations with a business line of credit or receivable invoice advance. That's basically you're borrowing money against the money you're going to receive from services already rendered. And then for marketing, a lot of times you can find a nonprofit or a micro lender that's going to give you that money to help you get your marketing out there, whether it's signage or just different types of online marketing. But those are good. Nonprofits are great for that because they're big in getting names out there. So that's a good start for them. And there could also be more than one type of loan that'll fit your needs. I recommend when you get into looking for your types of loan that you find yourself a mentor through a nonprofit or a small business development center, or somebody like Tori. She's a great mentor to help you put you in the right direction.
This slide is so helpful, even just knowing matching the funding with the need and the types and where to go for that. Because I think as a small business, we automatically think like bank or crowdfunding, and we don't necessarily think of the things in between or what we should go to a bank with, right? So maybe marketing is what you really need. And maybe that's not really what the bank can give. Well, now you know,
Right.
So instead of going and then maybe potentially being rejected and then upset and then, kind of feeling like, oh, I'm not meant to do this, kind of knowing where you should go to get the funds for what you need. So this is really just great.
Oh, for sure. A lot of times people come to us and that's typically what they're looking for, is something to get their name out there. It's really hard for a traditional bank to lend for just that because there's no real collateral, and it just doesn't make sense in a traditional bank. And the funds are usually smaller. So if you can find yourself a nice nonprofit or micro lender that's kind of their specialty, those small loans, get them really quick and you get your name out there. So since I'm in banking, we'll take a look at banks first here and see what makes the banks tick. So banks are very highly regulated by the government, with organizations like the FDIC, the OCC, and through the State Department of Banking, Federal Reserve. These people come into our banks once a year each. So there's always somebody in there just, taking a look at how we're doing our lending. Are we following all the regulations and just in general what we're doing? Because we're taking the public's money and we're lending it out to other people. So your deposits in a bank are what is used to fund loans to others. So there's very low margins in banking compared to other types of lending. Your rates are going to range from 4 to 6%, and the rates we're paying out on the money that's sitting there is around up to 2%. So typically, the bank's margin is 4% or less. Currently, with the way the industry is and their rates being so low, the margin for a bank is even smaller than 4%. And small business lending is the highest risk activity within a bank. So knowing that you have a down payment, that you have some equity or net worth in your business, what types of things are you leveraging, your collateral. These are reserves for unexpected expenses that may pop up. So do you have enough? Are you asking for enough working capital when you go into the bank? So we discuss that a little bit later here in these slides, but those are that's kind of how a bank ticks. Now, what's the best way to choose your banker or your lender? The number one way we tell people is find somebody who's successful and what did they do? Who do they go to? Because successful business owners have somebody they trust within the banking world. So number one is probably the best way to find a banker you can trust is through another person who's already succeeded. And do you want to use a big bank or a small bank? That's very important as well. Big banks do like the big companies. So if you're a national company, you have a high net worth, that's where big banks thrive. And your community banks are the people that you're going to see every day in the grocery store throughout the community. And those are the people that if you're a small one-stop shop type place, then you're gonna be want to look at your community bank to find somebody you can work with and trust and knows your area and what you're looking to do in the community. If you're looking for an SBA loan, there are preferred lenders that will help you match with a bank that is in your area. And then the lender match program is that within the SBA where they match you up with somebody in your area that understands what type of business you have. Once you find your bank and you find somebody willing to work with you, here's what someone like me is looking at within the lender's framework is we call the 5 C's of credit worthiness. Your character, and within that is, do you have a qualifying credit history? Have you been around a long time? Do you pay your bills on time? Those types of things. And do you have derogatory items and things you're late on? It's not, going to keep you from getting a loan, but those are what they look at. How often are you delinquent? And then your ability to repay the debt. Let's consider your capacity. Do you have the funds needed, or is that why you're here? You're close, but you need that little bit to get over the hump. Capital. Do you have money to put down? Do you have equity and net worth within your business? What can you leverage? And do you have reserves set aside for unexpected expenses? Because they're always going to pop up. Again, with leverage comes your collateral. What are you going to use to secure the loan? What are you going to use to make the lender comfortable lending you money? Putting something on the line is very important to banks. They want to know that you're all in. So even as far as life insurance, something were to happen to you, can you repay the loan? So they're looking for those items. And then the conditions around you, not just your business. What's the climate in your area? The local market, the national market, what's that look like? And can you meet the lender's terms within that industry? And is it a risky industry? There's certain industries that are super high risk, you're probably not going to get a great rate on. And then there's other ones where real estate is your thing, and you have strong collateral. And real estate's always a pretty solid investment. So banks lean more towards that, but they do business with other types of businesses. So now
I think
getting
that's all really
yourself
important
together.
to even just
Yeah.
understand what you need before you walk in. So
Mhm.
collateral, let me just go back a second. So like understanding
Sure.
your capacity to repay, your collateral, the conditions, the character. So, like I don't have any debt except, student loan debt, right? But it's a considerable amount.
Mhm.
So that is even difficult itself.
Oh, for sure. And they're looking at your credit worthiness on a global level. So they're going to look at your business as well as personal. And they'll, a lot of times for a startup, they're going to combine it, because if your income's coming from the business, they want to know, what are your personal debts? Can this business support the business debts as well as the personal debts? So that's something that you very much have to consider when you're looking for a loan and starting your business and or moving on. So getting your act together when you enter the bank, here's some items you're going to want to have in hand. Every bank's going to ask for these things. So you want to have them all together. Your tax returns for yourself, the business, anybody involved, and not just that front page that shows your revenues and how much you made. There's more within those tax returns that the banks look at. So you're going to want all the pages and schedules. It details out the expenses you've had. There's a balance sheet within there. And if you're not doing your own taxes, you have a financial person that does that for you. You probably don't know all those numbers. He kind of gets you to that bottom line, shows you what taxes you owe and how much you made. And that's where everybody looks. But within the banking world, we're looking at some of those other items. Also financial statements for you personally and the business on usually a semi-annual basis. Sometimes people do them quarterly, and we have some really good clients who want to know every penny, and they're preparing those monthly. Most banks don't look for them that way, but if you walked into me with financial statement on a monthly basis, I know you have your stuff together. So good to know. And then personally as well, annually you should be doing a financial statement to show your assets and your liabilities. It's good to know for yourself what your personal net worth is. And it also shows that you have your stuff together and you know where you are financially on a global basis. Credit reports, the bank is going to pull that really early into your relationship. So you should know before going in there what your credit looks like. And if there's anything out there that's derogatory, it's not going to kill a deal. But if you say, hey, you're going to pull my credit and see 7 years ago I had a bankruptcy, you called it out right away, you're cutting it off, you're giving the reason, and it's really shows you understand what's expected of you from the bank, and having the good reasons for whatever it is, because we all have issues at some point in our life. Just having the explanation and knowing ahead of time, it's going to come out, so you might as well bring it out right away. Work with a small business development company and get a business plan. Your local colleges all have these little services they offer, and they're very good. They'll help you prepare a plan with 3 years of projections and costs, and you know what your cash flow is going to look like, what the market looks like. They do all the research. You tell them what you want to do, and they give you a few little projects, but they put it all together in a real nice format. Banks understand it, and that's kind of the first place we send people when they have an idea. Go talk to your small business development center within one of the local colleges. And then supporting docs. Have you created your company yet? Do you have a business entity? Do you have a biography on yourself, a resume, something that tells us a little bit about yourself? Do you have leases in place, contracts already, those types of things? Bring all that with you. That schedule. Banks are going to ask for it. You might as well have it ready when you walk in the door. Also, next slide here shows something businesses don't usually think about when they walk in, is that it requires time to cover those upfront expenses. And many small business owners underestimate what those costs are to start the business, and then they overestimate their volume coming out the gate. So it usually ends up taking longer to recover those underestimated costs when you have overestimated volume. So a lot of times I tell people to do a break-even point, worst case and best case. So then you know, if you don't hit that break even, how long is it going to take you to get there? And then if you do hit it, what's it look like? Because a lot of times growth in higher revenues means higher expenses as well. And how can you manage that? So knowing those items and having kind of almost 3 sets of initial projections really is a good thing to have, and to know those items. Excuse me. And typically a business operates with a loss in the first year to 2 years, depending on the industry.
And that's also okay.
Uh,
And I think a lot of small businesses are fearful of trying to get
mhm.
a loan because they show a loss. But there's so much that you have to pay at the beginning of starting your business that if you do have a profit those first 2 years, that's really fantastic because you've paid startup costs and marketing costs and inventory costs and things like that. We have such an idea that we have to show so much profitability in order to get funding for something that if we feel like we don't, then it's like, well, there's not a space for me. I'd get denied right away.
Exactly, and that's why projections are very important. And if your
Say that again,
projections,
Jay. Say it again, that projections are important because so many clients that we work with are so scared of them because
yeah,
it is unnerving and we understand that. But really, that's going to tell you what you have to sell, what your price points are, where you have to go. It's going to dictate your marketing plan, your inventory plan, how you buy, how you source. There's so much sense of fear with projections that's kind of where people stop and they kind of just disappear in our process because they're so worried of it.
oh, for sure. And if your projections show you don't make money to year three, your banker's not expecting you to make money until year three. So if you're projecting money in year one being profitable, then you have your tax returns that you have to turn into your bank every year, and you're like afraid to turn them in because you have a loss. It just, if they're expecting the loss, they're going to see it. That's just what it is, and we rely on the projections for the first few years. And if we know there's gonna be a loss and there isn't a loss, you just hit the ball out of the park. Great, it's even better. But showing those losses early, knowing that they're going to happen the first 2 years, also sets you up to ask for more money initially for that working capital so you can get through these loss periods. So having projections that aren't out of the ballpark just sets you up to get to the point where you are making money and having that money to fall back on. It's better to ask for more now and be able to pay it back early than to not ask for enough and have to come up and say, didn't quite do what I expected, so I need more money or else I have to close. So again, ask for a little more, but make sure you have projections to back up why you're asking for it. So probably one of the most important things you're going to take to your bank. All right, so then we have some examples of what a traditional loan would look like. So this situation, somebody's looking to expand their floral shop, and the traditional bank loan is a good fit for a business with proven financial results, um, satisfactory financial statements that are put together in a business that's has a strong business plan with the projections in there that are reasonable. And then a favorable credit score is very important. It's not going to keep you from getting a loan most of the time, but it improves the kind of interest rate you're going to get, because the interest rate is based on risk. So if you're riskier because your credit score is low, your rate's going to be higher. As you improve that, you're going to get better rates. So something to focus on yourself and the business. So. And your sources could be a conventional bank loan or an SBA loan. And the SBA does both kinds of term loans and revolving line of credits. The revolving line of credit is the managed cash flow. So if you're that type of industry that's based on cash, a lot of times those are necessary. Other types of lenders and programs that are out there are nonprofits and micro lenders. So we get a lot of clients that ask about government grants and microloan products. And these are options for entrepreneurs who meet the requirements. There's more requirements in these types, but they are very helpful. A lot of times they're going to give you pretty good interest rates as well. And these nonprofits do have different programs where they're going to be able to coach you through the whole entire time you have a loan, because they're typically a shorter period loan. And they have good rates when we're not available as a bank. For example, some of these government programs they have for minority owners, military veterans, and economic development programs. So if you're improving your economy around you, you're in a underserved, underprivileged area, typically there's going to be some nonprofit help, some government help out there to help you get that community up and running. There are foundations and other nonprofits that offer microloans to startups, because that aligns with their mission statement. And these are typically smaller loans.
And
Example of
with the E3
nonprofit loan.
Alliance, with the E3 Alliance, we have a great relationship with Ridgeway Capital and Kiva.
Mhm.
So Kiva is housed within Riverside Center for Innovation, and that's where we're housed at as well. So Emily Keebler is the person who's over Kiva in Pittsburgh, and she's wonderful. So if you're interested in a Kiva loan, if you're interested in what that means, please contact me and I could connect you. As always, my email is tori@e3alliancehub.org, and we could connect you and kind of help walk you through what a Kiva loan is, what you need to have set up, how to advertise for it, how to, get your supporters and your donors in. There's kickstarting programs, there's crowdsourcing, there's honeycomb. I mean, there's a lot of ways to find these, kind of micro loans, as you were saying.
Yeah, definitely. And that's why you're a great resource as well as some of the others in the community. And some of these nonprofit loans are usually micro businesses, one location, and you can leverage a small loan and eventually grow it into some good profits and something good for your community. Again, like I said, they're big in the underserved communities. And these community development agencies offer the microloans, help businesses in the inner city and similar improvement areas. So they also, like I said earlier, offer military and veterans some discounts and some different programs that will help them get moving. We like to keep our veterans off the streets and getting them involved in the community and helping them find their dream and something they want to do for the rest of their lives is always very important. So one of the questions we often get is, what if I don't have a good credit score? So many nonprofits look at other data to mitigate the risk of their loan. In some cases, your credit score is only a little part of the equation. Kiva Zip will offer a program. If you can find people in your personal network to lend $5 each or something like that, they help you that way. So there's other ways to improve credit and get others to support you, because reputation to them does matter in their decision-making process, and Tori can account to that for us. And if you need a little more money than just a few $1,000s, nonprofits and microloans, you can sometimes combine different programs to get to the amount you need. So, and they all work together often enough that
that's such a good point to notice, Jay, is that there's a misconception that if I received money from one place that I can't get money from somewhere else. And so like if I got a Kiva, well then, I can't get a bank loan. Or if I have a bank loan, then, I can't go for Kiva, or I can't do this. And that's not the case. You may not be able to get two financial fiduciary loans from a bank, depending on what and how, but there's all these other areas. So grants and business credit cards, or Kiva, crowdsourcing, crowdfunding, Kickstarter, honeycomb, Kiva, etc. like that. There's other ways that you could do that. Even fundraising for yourself, donations, you need food trucks are a big thing, right? And so you need an item for your food truck, and there's a set price. And so like Shine Registry is a really great resource. Shine Registry is actually like baby showers and wedding showers for a business. So you put things that you need for your business in there, and people can either give that dollar amount. So like, here's your panini press, or here's your this, right? Or they could donate and that money goes, or they can give you something and say, hey, I have a panini press. It's brand new. I'm going to gift it to this person because it's listed into that registry. And the founder's name is Emily. She's based here in Pittsburgh, also another really great resource. So it is good to know that you can find ways to do this without it being just one way, one track to find financing for your business.
Oh yeah, that's awesome. I hadn't heard of that type of thing. So it sounds very interesting. I know the other crowdfunding ways to do things, but never heard of that one. And I really like the sound of that. So like you had mentioned, business credit cards. They're a great way to establish credit for your business, because not only do you need personal credit, but there are certain ways we pull credit within a business, and having credit cards with positive credit score on that business is very good. Good way to build your name within the credit industry so that you can get loans going forward. because initially you're looking at 20,000 or less, but if you start growing and things take off, you could be looking at 400,000 or more. So having good credit within the business is good. And those business credit cards help in a pinch. Even if you don't need the money now, something breaks, you need to buy something new and it's a smaller item, you just use your credit card. The interest rate's relatively low on those if you pay on time. And you can eventually, if you're doing that, there's ways to refi that money out through a loan longer term. So credit cards aren't your enemy. Another item you might need is equipment for your business, and equipment leasing is a great way to finance what your needs. Equipment leasing is often cheaper than purchasing, and a lot of times through these entities, they offer the lease to own. So if you don't end up buying it upfront, you can eventually, through your regular payments, own the piece of equipment. The companies that do these often have better rates because it's almost like when you buy a car, going from the dealership, the rate's often better than finding the car and then going to your bank. It's their specialty. They get good rates. They offer better rates out. And a lot of times before you make the big investment into purchasing, if you don't know your business is going to be successful, why not lease it and not have that huge upfront cost? So this is another item you want to talk to your accountant about.
Yep.
Does it make more sense to purchase because of the whole depreciation factors, or is it better just have that little expense on your income statement?
And there's not shame in knowing that you're leasing or renting something for your business and don't outright
Right.
own it, right? So there's this idea in America that like I should be ashamed if I rent my home and I don't owe. I should be ashamed if I lease a car and I didn't buy it, right? Or I should have shame because I didn't have enough money to buy this equipment or whatever else. The point of leasing is does it work? Is this what you need? Do you have it, right? So I'm thinking of people that do like the Cricut businesses and they need the big heavy duty heat presses and they're like, oh, well, I can't afford that. I'll just buy 10 of the smaller ones. Well, then, they're smaller. The same amount of time is going into that times 10. It's not decreasing your time. By the time you're done, you spent the same amount of money. So why not lease a big one, see if it works. If it does, then that's the one you want and you pay on it. Or if it doesn't, then it's like, oh, that didn't work. Okay, cool. Let me try something else out.
And another benefit to leasing is if it breaks, it's not yours. You've paid, part of the lease has the service in it. It can be fixed by them, or they'll send you a replacement. You send it back. So the downtime for the piece of equipment could be less if you don't have to come up with the funds to fix it right away. So it's a good option for a lot of people. And then if you end up needing that equipment, you use it all the time, and you have a guy on hand that can fix it or whatever, then it does become beneficial to lease your equipment. So don't be afraid of leasing. Friends and family. This is good and the bad. So if you have a close family, they're going to be there for you. They believe in you, and they have a little extra money. Maybe they'll give you the chance and help you realize your dreams. But sometimes you're giving up some of your ownership if they want, I'll invest in you, but I want, expect to get it back. And others, maybe you have a rich great grandfather somewhere that's going to leave you some money and he gives you an advance on that. So we have a lot of people that use friends and family to get their business started. And when they make it, they pay them back. And, often people have family. They're like, I don't want this back. This is my gift to you to realize your dreams. But depending on your relationship with your family, don't be afraid to ask. Worst they can say is no. So, and we have venture capital. What the heck is that? Shark Tank. That's where I go. Everybody's at least understands how Shark Tank works in one way. They stop on it when they're flipping channels because they have a weird product on there. And Rob Gronkowski's trying to sell you something, but he made it on Shark Tank, and he got the money he needed, probably because of his status. But you don't usually make regular payments to these people. They just kind of end up with some ownership in some way in your business. they invest, they're looking to get something out of it. It's an investment to them. So sometimes they take a percentage of ownership. Sometimes they take a percentage of some sales for a first period of time, or revenues. But they're always looking to get their money back with something. So not always the desirable way to go, but sometimes it's like a last resort. And it gives you the idea if your product's going to work. These people are very savvy. So if you go to them and here's my product and they think it's going to work and you can show them it's going to work, they're willing to take the risk.
We just did last week or 2 weeks ago, Brandon Brooks, who is one of the founders of a venture capital firm, and he's based here in Pittsburgh, and they're funding primarily Black and brown and women-owned businesses. And he did a whole webinar on what venture capitalism is, what you need, who should approach, the advantages and disadvantages, and how to get kind of your pitch deck and everything together. And it was really fantastic. So you can go back and reference the E3 Facebook page because the video is live from there. But a lot of people don't know how to enter that realm either, or they think venture capital is just tech. And while that's predominantly where a lot of the money does go to, it's not where all the money goes to. So just like you would research a bank, you'd want to research which venture capitalist or firm is looking towards or supports kind of what your industry or your product is.
Yeah, for sure. I mean, sometimes you just need to make that initial investment to buy the product. And that's where they can come in and they'll say, yeah, I think this will sell. Let's buy 1,000 pieces and see how it goes. And their investment is in that first 1,000 pieces, and see how it goes from there. But it is a good way to start sometimes, depending on what you're selling. But it also can cost you a little bit of what you make typically. So don't want to get in long term with those guys if you can afford not to. Then we have crowdfunding, as Tori mentioned earlier. These funds are gifts. There's no repayment. It's almost like the GoFundMe of starting up my business. So good way to start. Usually you can use this to try and get your down payment money for a loan. This is big with the younger crowd that understands it, the millennial group. For me, I think I'm slightly over the millennial group, so I'd be a little embarrassed to try this. I don't know why, it's just some pride thing, but the younger group is like, hey, this works online. Just let people see what you want to do, put it out there, and maybe they'll give you some money. So it's a good way to find that money early on. But next slide kind of gives us an idea of how crowdfunding works. So your needs are $15,000. You post it out there online on one of these sites that they have, Kickstarter, WeFunder, GoFundMe, and then all these individuals throw their money in. $5 goes a long way to start. If you get a lot of people throwing $5, it adds up quick. This is a relatively new way. Like I said, if you're the over 40 crowd, you're kind of like, will that work? But the millennials, the younger 20s, 30s will tell you that it probably will work. If you have a good enough idea and you have a good enough group of followers, post that on your social media. And like I said, enough people give you $5, it adds up quick. Some examples that we've seen.
For my birthday, for my business, when I had first started in 2020, my birthday that year, I did a fundraiser for my own business. And normally on Facebook, I do like a fundraiser for a nonprofit that I support or I'm on the board of. And that year I said, like, it was a plea, like, hey, I just started a business, pandemic, I'm out of work, as a single mom, this is, I'm trying to build a business and a legacy. And my goal was to raise $500 and I ended up raising $3,000, which was amazing,
Nice.
right? To start for my business. And every time a donation came in, it was literal tears because it was people who were like, go for your dream. We support you. We love this. Like, you give back and now we get to give to you. And it was really kind of a testament to like putting yourself out there. And I didn't have a goal, right? It was like, if I hit $500, like I could get this for the business. And then when I got, I had to keep increasing the goal on Facebook. And I was like, I don't want to do this again. I don't want people to keep thinking I'm reaching, right? The person in me was worried. And my mom's like, yeah, I wouldn't increase it again. And another person's like, yeah, so I just gave, like, you should increase it again, at least like $15 and see if you can hit that. And so I think I increased it 3 times. And at that point, it was like 8 p.m. and I was just so full of love. So I mean, that's one way, right? It's just like, it was just a plea, like, I just want to start my business. And I
Right.
remember all the people who donated. I wrote them all a thank you note and I put it into the mail, like full-heartedly thanked them for their investment into me. They didn't get anything back. I mean, maybe something. Eventually, some of them have gotten something from me, like a consultation or a free goodie, but at that exact moment, I had nothing else. They didn't get a piece of my company. They didn't get a shout out. There wasn't anything that they got monetarily connected to that donation besides goodwill and just kindness. So if you
Right.
are in need of just a little bit of amount of money, consider doing something like that with a fundraiser or a crowdsourcing, or just kind of like a, hey, we need $1,500 for something. Like, anything that you could donate would be great. People will. Not all, but
Yeah.
people will.
Right. If you get enough people to stop on it and share it, you can get it. It's also a great way if you have a new product and you want to see if this product is going to be something people like. Um, you can find out pretty quickly. If nobody's donating, they're just probably like, that's not going to work. But if you can get the donations, it kind of gives you a good idea if your product's something that's going to work or that people are going to need. So um, doing that, showing that you have the expertise in that area, showing that you're going to be able to make it work kind of in the way you present it is huge. But I think it's a great way to get that little bit of money you might need to either start or to get a new piece of equipment or to get the product up and running. So another good way. So here's a way that banks don't like. But if you're an existing business, it does a lot of merchant sales through credit cards. These merchant cash advances can get you the money quickly. You don't have to have high credit scores, and the payments rise and fall with your sales. However, it's very expensive. They're taking right off the top a portion of what you sold. A lot of times it's daily. So if your sales for the day are 500, they're going to take their 150, whatever it is, right out of that before it even hits your account, because it's coming through the merchant. They intercept it from the merchant card where you swipe to the bank. It's intercepted in between there at the percentage that's agreed upon. They can work short term. If you get stuck in it longer than the original 6-month period, you're going to get in a cycle where you borrow more, they take more, and it's usually downhill from there. So it's very like I said, very quick to get the funds, but it's very expensive way to borrow money. I put this as one of my last options to borrow money. And when you do sign up for one of these, read the contract very carefully. Because also a lot of times they take their portion, and in 6 months they want the rest. And that portion you've been paying all along is not, principal. It's a lot of times it's what they're earning on it. So be very wary of those, but they can work if you're in a pinch. So here's this next slide's kind of the situation, broken out for you. A small bakery has 70,000 in 60 days accounts receivable, but needs 20,000 now to pay their current bill. It's short-term borrowing versus against these invoices that you have outstanding. The cash flow fluctuations are one of the people that it's good fit for. But like we said, some factoring and some asset-based lenders are the ones that are going to be doing that loan. Just factoring itself is pricey and not so risky, but those other ones where they're the merchant ones are a lot more pricey. There's online companies like Bluevine, Fundbox, offer internet-based services for borrowing against your accounts receivable. So in essence, you're selling your accounts receivable today to them, and you're going to pay the fee for it. So they're giving you that money now that could take 30 or 40 days on a regular accounts receivable. But then when it comes in, you owe them that money. As you can see, there's the caution sign on this slide. So you just want to make sure you know what is involved in this contract and you're not selling your profits away.
Well, and you really want to read the fine print with this because it can be predatory. Check with your bank who you do your business banking with. I business bank with Huntington, and I do know that my business account, I I think it's like $1,000 of like emergency access. So the idea is that based on how much money comes in and out, that money can change, you know, ebb and flow. But that say I have to pay for something and I don't have that money in, I get a grace period where there's not an interest fee on that $1,000 if I borrow it for my business from that bank. It has to go back, it has to pay back, but there's not an interest, and there's like certain parameters too, like there's a time frame or something like that. But what's especially good to know about that is like at the holidays, I'm a retailer, so buying my inventory in October, I'm not going to get the money probably until November or December. So net 60 or net 90, well, what do I do unless I had big summer sales? That's a really great way where if you have that emergency, you have to tap into it, you can. So one of the things that I will really suggest is no matter who you bank with your business, whether it's a really big national or local or semi, you know, big, ask what services they offer to you for their small business.
Oh, for sure. Doing this through a bank is way less risky than doing it through one of the online companies or the internet-based ones. So that's a great service your bank offers, and if you can find that within your bank, that's way less risky than using an online service. So sounds like a great product you have there. So I definitely, if you can find something like that, highly recommend it.
Yeah.
I'm available to anybody that might.
End.
Yeah.
Right. So we're at
Great.
the questions. So definitely scan this so you can get to Enterprise Bank. Jay has been a great asset for us. If you are in Beaver County, we have a really, really great announcement for you. So Enterprise Bank and Jay is pairing up with the E3 Alliance of Greater Pittsburgh. And starting May 13th, which is a Friday the 13th, we will be at Old Crow in Ambridge, the coffee shop, setting up shop from probably about 11 to 2:30, where you can come in and you can just chat about business accounts, business plan, projections, banking, financing, have questions for Jay, have questions on marketing, need resources. We as the E3 will be there to connect you to the resources, and Jay will be there as the banker to kind of help you and guide you and give you a little bit more information on enterprise, but also ways to be able to funnel money and get money for your business.
Sure. I look forward to this. It sounds like something great for these communities, and yeah, good for us to get our name out there, but it's all about helping people, you know, get their businesses open and established. So looking forward to these meetings we have. So
Absolutely. And Enterprise Bank is just located in the North Hills, so it's local to us. And no matter where you are in the greater Pittsburgh area, that's easy enough to get to. So we're really excited to start this relationship with you, Jay, and Enterprise Bank. Stay tuned for more webinars that are coming up and a schedule of where we'll be popping up in May, June, and July with Enterprise Bank. And thank you, Jay, again, for all of your help and your support.
Thanks, Tori.
If you have any questions, please feel free to email Jay or reach out to me. Thanks, everyone. We'll see you soon.